Expecting rate cuts, but crude oil just changed the entire global market scenario. Now, institutions were pricing in rate cuts this year, especially for US, and at the same time, if you take a look at the current bond yields, the US ones, and especially the Japanese bond yields, they are saying something else. When we take a look at crude oil prices, that has stayed, I think it stayed elevated for the past 4 months right after this ongoing war, and it has started rising way before that. So markets were pricing in something negative right before the war began even. When we take a look at the 3 months chart of WTI, I do not have Brent crude right now. I am only taking a look at the US oil or the WTI. Now when you take a look at that, and this is a 3 months chart, you guys can clearly see that crude oil has an inverse relationship with the equities market. So if crude oil moves higher, we see equities going lower, because economically too, when crude oil stays elevated at a higher price, inflation starts to move higher as well. And Fed's pivot or Fed's benchmark for inflation remains at 2% or near about 2.1 now. All of that is fine. The current inflation rate is at 2.4. We'll get onto that later, but as of now, let's start talking about what could crude possibly lead to. Now, crude is currently sitting at 112. From a 3 months chart perspective, you guys can clearly see one thing that happened in the past. This is exactly 2008, or crude oil prices started to move right from 2007, kept going higher until 2008. That was almost a year's rally. And that was the same year where we saw the Lehman Brothers crisis and the housing market crisis. Now, if I add SPX to this chart from a comparison pane perspective, you guys will be able to understand how inversely is SPX correlated with crude. Now, let's take a closer look. When we go right here, you guys can clearly see when crude oil started to rise or make a base from here, this is exactly where SPX topped out, went down right away, and crude oil kept getting higher. The moment crude oil started to fall, we saw a rebounded rally and it kept going higher. That means when crude oil started to fall, equities started to rise as a whole. This also means that once we see crude topping out right now, or maybe in the upcoming months, that's going to be an added confluence for all of us. If anyone who wants to invest, or the ones who are looking for longs or are just perma bulls, let's run back and try to backtest this again. Now, we again saw SPX rising right from here and falling. You guys can clearly see this was the exact area where crude oil kept going higher, and exactly we saw a fall. But crude oil prices stayed elevated until this drop, and we started moving again. The same time in the past, you guys can correlate, whenever we've seen equities rising, crude oil keeps going lower. Now, what is the current scenario? Let's talk about that. See, based on the current market scenario and where crude is currently sitting at, we need to understand one thing. This is a 3 months chart, and to analyze or refine our charts, we'll have to come down to a shorter time frame. I am using the weekly time frame because using 4 hour and 1 day right now is just good for short term trades and not something that would help us build a bias. Now, from a price action perspective, if you take a look at this zone, which happens to be ranging from 123 to 129, markets quite likely are either going to be deviating right away from this zone, or else is going to be deviating above. Now, what I basically mean is, a lot of people will be considering this zone as a supply zone or a resistance zone. So everybody is going to be placing shorts here. Liquidity is either resting below, a crucial support that a lot of people usually mark, or else we are going to be deviating all these shorts here. Whoever is going to be shorting here, take out the whole liquidity, deviate above, create a buy side liquidity clear example, and then we start to roll out a reversal for crude. That highly depends on what the war catalyst is going to be rolling out on. Now, if the war starts to sustain and it starts to, keep going the way it is, we are not going to see this scenario rolling out. Rather, we are going to see small retracements factored in and backed up by larger pumps towards the upside. However, if we see a clarity and a clear conviction on war that yes, it's getting rolled out and it's not going to get escalated further, we are likely going to see crude falling back again. And this is the best case scenario for equities. Okay, now let me talk about what inflation and what is the current buzz about rate hikes. Now, one tool that a lot of people use happens to be the Fed CME tool, and all the rate cut probabilities for this year's. I mean, this year we were usually looking at, or basically looking at, two rate cuts, 25 BPS, and that was somewhere around 50 BPS as a total. Now we are not looking at any rate cuts, rather, we are looking at rate hikes, because if you take a look at the current inflation rate of US on a year on year perspective, it's currently sitting at 2.4. Now, something that you guys need to understand, what happens is when crude stays elevated for a longer amount of duration, you're not going to see a direct inflation spike, but progressively it's going to start increasing. And when this increases, Fed's pivot sits at 2%. Currently, the inflation is at 2.4%. Now, if this rolls over to 3% or maybe more than that, Fed will be left with no other option but to start hiking rates aggressively, and this is going to be leading to another equity crash, because this is another catalyst that is going to be adding up towards the bearish scenario. However, if crude oil starts to settle down, like I said, if we see clarity on the war getting de-escalated, inflation prices might maybe shoot up to 2.6 or 2.7, maybe, and then start to cool down again. So Fed can only cut rates when the inflation is under control and to feed in money inside the system. However, if inflation stays elevated, there will be a very thin room or slim chances for Fed cutting rates but hiking rates more. Now, another scenario. Based on the current CPI, we also saw the NFP coming out this Friday, and that was another trigger for the Fed to understand there is no need to, cut rates this year. That's fair. If they don't, start hiking rates, that's fair. They could possibly stay on a hawk, probably on like a watch notice where they just try to see things, how is it going. Instead of being hawkish or dovish, they would just sit like a hawk from a perspective that just sit and observe. Now, when you take a look at the NFP, which came out last Friday, this consensus was sitting at 65,000 jobs to be added. However, we saw 178,000 jobs getting added. Now, this means that the economy is resilient and it's strong. Whenever we see that, let's say the target was sitting at 65,000, and if we would have seen a target coming out at, let's say, 30,000 or 20,000, that means there's a contraction in the economy from a perspective, less jobs getting added based on whatever the target was. There needs to be liquidity in the system, and this is where Fed thinks about cutting rates. Based on the current scenario, this has just added to the catalyst of Fed not cutting rates based as of now. Doesn't mean that Fed might not cut rates if everything is on top of the cherry. Okay. Now, another thing, Fed doesn't think about the stock market much. Okay, the job of Fed isn't to pump markets. Yeah, up to a certain extent, the federal meeting every month, it creates a lot of volatility. However, the main job of Fed is to keep rates elevated and at a stage where everything is neutral. So the Fed doesn't care about stocks. If CPI rises, it's quite normal and literal to see Fed raising hikes and the rate hike bets getting raised on the table again. Now we'll take a look at what could US indices possibly, fare up to, and some levels that you guys can probably watch as an investor or maybe as a trader. Now, on a weekly chart, what I've basically marked up is I'm keeping my charts very simple and not complicating it from any perspective. Two, three things that I'm basically looking out is we saw a buy side liquidity, stop here, getting deviated. We started to fall. That's fine. That's done already. based on the current price action, we saw a bullish close on a weekly time frame, and this is a positive candle. Okay, if this candle was this small, maybe up to here with a wick right above, I would have considered that as bearish, and we could have seen a reversal follow through. And what I basically mean is, a candle getting flown right towards the downside if this candle was small. However, this shows enough strength, and we could possibly see prices moving more higher as the war starts to de-escalate. If it doesn't, we might see some moves and then it's going to get followed towards the downside. So two scenarios that could possibly play out. From a bullish perspective, we start moving up to this level, and this is the exact area where I am waiting for a structure shift. Okay, if we see a structure shift here with some retracements and consolidation, fair enough, SPX might print a new high. That's the best case scenario from all the economic and structural perspective. However, if we do not see this rolling out, we will possibly see indexes going lower, and here's my weekly fair value gap or a drawn on liquidity that I'm easily seeing getting tested. Now that sits at 6076 to 6100, near about a 8 to 9% drop on the scenario where crude oil moves up by another 10%, the war gets prolonged a little, and after that we might see some rollover. But yeah, if we start to consolidate here, then only we might see a reversal. So this weekly fair value gap, let's say, even if it gets filled, that doesn't mean that fine, you can just blindly long here and markets are going to rise. No. From a confirmation perspective, you will have to refine your time frame to 1 day and 4 hour. Look for a base building and markets to stop falling, and then only we'll see compression and a rise. If we do not see anything of this sort, then we are likely not going to be rising. Rather, we can fall more lower, and that could possibly lead to lower levels up to 5,400, or maybe up to this wick that it created during the tariff period right after the election of Donald Trump, up to 4,700 as well. Like, we never know, anything can possibly roll out inside the markets. However, these are some levels that you guys can probably watch out. The current bias based on this candle remains bullish. We could possibly move higher, and then that's where we could start seeing pressures towards the downside. Now coming back to Nasdaq, so same thing over here. Buy side liquidity got deviated, shots got placed, we started falling. All of these wicks were all indecisive candle price action. The current candle closing looks solid from a bullish perspective, no doubt about that. We have retraced to somewhere about 7 or 8%. I think the current retracement was more than 13%, and we've started to jump. Some level that I'm looking for a market structure shift, same like SPX, happens to be 25,454. If we flip this level and start to consolidate here, we could possibly and or easily see a new high in Nasdaq. If it's not getting respected, the other bias is going to be bearish, and from an economic and a geopolitical perspective, that's only going to happen when the war gets prolonged, like I said. And we could possibly see inefficiencies sitting at 22,000 getting filled. Lower, we might go and fill this liquidity void that none of these candles have ever filled. So it's still setting unsettled. Another index that I'll be covering in today's video happens to be Dow Jones, and that's the last index that I'll be covering. I'm just looking at the US 30 is right here. Another thing, we have a fair value gap sitting here. Okay, not yet filled, waiting for that. A good bullish candle with a good follow through. This was the high. I am waiting for prices to flip 49,000. Now from a level to level perspective, if I just want to talk about levels on the daily, I would look for Dow Jones to basically fill this fair value gap, and move higher. However, let's say if this fair value gap is not getting respected. Now, fair value gap is not the only thing that's going to move prices higher. We could even see some more exhaustion towards the downside, because a lot of people will go in delirium when price starts to deviate this. We make a quick wick here by testing 43,000, and that's the place where we start reversing parabolically. That could also possibly be a scenario on other indexes too. So if we deviate the recent low, test these levels, see a quick whip getting, bought back very quickly, that's also going to be a place where we could possibly reverse only if this fair value gap is now getting filled. Okay, now these are some levels that you guys can possibly, look out for. However, like I said, there are only two scenarios. If the war is getting, settled, everything is getting de-escalated, crude moves lower, equities move higher. Equities move lower, crude moves higher, war gets prolonged. That's the worst case scenario that could possibly roll out in any of the either cases. Things that you guys should be watching out for: if inflation cools down, then it's going to be bullish. If we see elevated inflation or war getting prolonged, crude oil prices staying higher, it's going to be a tough job for the US Fed to cut rates in a scenario like this. Some things that you guys should be watching out as an investor and a trader perspective are: don't over leverage, be it on longs, be it on shorts. Watch out for the CPI very closely, the new months or April's CPI. And the last one are: watch out for the key levels on crude and the levels that I've mentioned. That's it for today's update.